Good Monday morning. It's just half an hour away, of course, to the opening bell. Hong Kong, Shanghai, and Shenzhen. You're watching the China Show. I'm David Ingles with Rebecca Choong Wilkins.
Our top stories this morning. China is battling persistent deflation pressures with consumer prices falling below zero for the first time in a year in February.
Now, economic surprises in China and in the U.S. are weighing on risk asset stocks and also boosting bonds, as you can see here. President Trump warns that the economy is facing a transition period while refusing to predict a recession.
Also ahead, former central banker Mark Carney wins the race to become Canada's Prime Minister, promising to keep retaliatory tariffs on U.S. goods.
Plus, a new Chinese-developed AI tool called Manus gaining popularity and stoking bets on another DeepSeek moment. Welcome to the show. Happy Monday morning. Hope you're all well. There's a fairly observable tilt lower as far as risk appetite is concerned. The reason I bring that up, you don't normally see moves like this in U.S. futures in Asian hours. You don't normally see a move like that across the Treasury curve lower in Asian hours as well. So, I mean, that being said, we are coming off lows a little bit as far as this and those are concerned, but certainly it's something to watch as we move into the thick of the Monday session. You do see, of course, sort of playing out here across the bond markets. Equity markets, though, in the Asia Pacific are holding up decently well, and we'll see what happens when Chinese markets open up. Just a quick note on the dollar, and of course you have the best iterations here on the move up in the dollar, right? Biggest weekly drop in the Bloomberg dollar index last week. So you are seeing some, maybe as far as the yen goes, specifically near overbought levels there as we approach these 5-month lows on dollar yen. Right. In fact, just chime in on this. Our question of the day, you know how to reach us really on this juxtaposition between U.S. and EM assets. Should traders start pricing bets for a U.S. recession? 3 cuts are now priced. The jobs data, of course, we're coming off that as well on Friday. 3 full cuts, I should know at last I checked. That's a few seconds before I came on set. Very quickly, change the board, please. U.S. session, as far as Chinese assets were concerned, 0.5% on Friday. We're looking at a lot of the EV plays, a lot of the tech in focus. Manus, of course, we'll get to all of that in just a moment here. Just a note, of course, on AI and XPeng as well. The company's chairman said that they will be mass producing a flying car going into next year. Right. The approach to the Chinese Open today. So you have the equity markets here. We're watching this one very closely as well. This melt up in yields, which, at least when you look at some of the commentary coming through BNP, they do expect the yields to continue to climb up a little bit further. This re-rating that we are getting across the economy, this catching up trade on the long end of the curve. And Shanghai crude, as you can see, up to 2% in the early goings. But I guess the bigger story is really in equity markets and what we see there as far as tech goes. Rebecca.
Thanks, Dave. And just crossing now to Beijing, we're going to take a look quite shortly at some of these live pictures from Beijing, where the CPPCC is holding its closing ceremony as part of the annual 2 sessions. And I think we might have President Xi Jinping now on stage. We're just keeping an eye. For the very latest, let's bring in Bloomberg's China correspondent. Oh, here we go. Sorry, zooming in on Xi now. I can finally see him. Min Lo joins us to help break down the very, very latest. Of course, we're keeping an eye still on inflation data, as well as some of these retaliatory tariffs.
Yeah, certainly the context there is really an economy that, when you look at the early goings of, the momentum coming through, right? So you have everything from high-frequency numbers. The travel data during the holidays in late January actually boosted that conversation. And then we had all the promises around DeepSeek, the feel-good factor coming through across these markets that melts up in yields. And then we had a reminder on the weekend of the inflation numbers, which you alluded to there. To put everything in context for us, Min Lo, as Rebecca was pointing out, is in Beijing for us. Min, where do we start here?
Hey, yeah, you're just looking at pictures there. Wang, the CPPCC chair, speaking. But yes, we got the inflation data over the weekend looking pretty weak. The inflation consumer price index coming in at negative 0.7% versus a 0.5% rise the previous month. And it's largely because of seasonal factor, because Lunar New Year last year fell entirely in February. This year it fell between January and February. So that really dragged down food prices there, down 3.3%. A big weighing heavily on that broader index. But even if you strip away that more volatile food and energy prices, you look at the core inflation, it's still negative 0.1%, the first contraction since 2021. And in fact, just the second time we're seeing a contraction in over 15 years. You combine that with the trade data we got last week, where imports had collapsed by about 8% or so. It really shows how weak domestic consumption is, and a part of that is because exports has been down as well. And when exporters kind of sell overseas, they have to sell to the domestic market. That puts further downward pressure on prices. Of course, looking forward to March, that could give us a better sense of where this inflation trend is headed, given the government stimulus so far and also stripping away the seasonal factors. One thing that stood out to me was that consumer goods as well, the prices there are down also about 1%, despite the equipment upgrading program that the government has rolled out so far.
Min, I mean, closely related to this, we now also have seen China impose retaliatory tariffs on Canadian goods. That's a response, obviously, to earlier Canada imposed 100% tariffs on EVs, 25% tariffs on certain Chinese commodities. Just give us some context on how strong China's response is here.
Yes, so China is imposing 100% tariffs on Canadian rapeseed oil, rapeseed meal and pea products, plus 25% tariffs on pork and some seafood imports. So you look at the scale of it, 100% and 25%, pretty much matching the Canadian tariff rates on China as well. So very proportional, in stark contrast to how China had responded to the U.S. tariffs, which were largely less than proportional. So it's a clear signal here, China firing this warning shot to Canada that they are going to react aggressively to any potential future tariffs, because the timing here is interesting. China took about 5-6 months to respond to those tariffs that were first imposed in October by Canada. And it's coming as that trade war is hitting up, when Canada is facing a lot of pressure from the U.S. to match the U.S. tariffs on Chinese goods, just as Canada is also preparing to start early talks with the U.S. reviewing that North American free trade agreement. So China clearly sending a message here that there's less room for negotiation with Canada than compared with the U.S.
OK. Bloomberg's Min Lo there, our China correspondent in Beijing, following every step of the way, really, through the MPC conference. And in just a few minutes, we'll be getting more analysis on the Chinese economy. We'll be joined by Wang, that's China director at the Eurasia Group.
Right. So, I mean, we bridged that story between China, the sort of tariff conversation with Min there, and of course that really takes us directly into the major developments out of Canada a few hours back. So you had the former Bank of Canada and also the former Bank of England Governor Mark Carney has won the race to become Canada's next Prime Minister. He is pledging to protect the country's economy, its sovereignty, amid the uncertainty certainly due to U.S. trade policies.
The Canadian government has rightly retaliated and is rightly retaliating with our own tariffs that will have maximum impact in the United States and minimum impact here in Canada. And my government will keep our tariffs on until the Americans show us respect.
Laura Kane is with us, our Ottawa bureau chief, to talk us through this. Laura, well, first, good morning from Asia Pacific. Thanks for joining us. Some strong words there from Mark Carney. What does this mean initially for foreign policy, particularly between, of course, them with Washington, D.C.?
Carney is absolutely saying that he's going to keep the pressure on the U.S., continue to retaliate, not back down until Donald Trump removes his tariffs on Canadian goods. He phrased it really interestingly as well, saying, "We will keep our tariffs in place until the U.S. shows us respect." So you can assume that he does mean, he has said before, that our retaliatory tariffs will stay in place until Trump's tariffs are removed. But he's also calling for the U.S. to stop its sovereignty threats against Canada, stop saying that Canada should be the 51st state, and start treating it with respect and reliability as a trading partner. At the same time, as he lays out his policy for dealing with the U.S., he's also saying, I'm going to expand Canada's trading partners, and I'm going to really break down sort of internal trade barriers within Canada so that Canadians can do a better job of trading with each other from coast to coast to really strengthen the economy as it faces this awful external threat from its biggest trading partner.
Laura, I want to follow up. What do we know about Carney's relationship with President Trump? Of course, he somewhat presented himself as this sort of even-keeled political outsider. I wonder to what extent also that plays into how he is going to frame Canada's relationship with China.
Those are two really great questions, and it's going to be a fascinating relationship that we'll see unfold between Mark Carney and Donald Trump. Mark Carney is a sort of more dry technocrat than Justin Trudeau. Justin Trudeau obviously has some penchant for dramatic flourishes, and Mark Carney is, a lot more even-keeled, as you said. He's presented himself more as someone who can be sort of a steady hand at the wheel as Canada sort of enters this tumultuous storm. So it's going to be interesting to see how he interacts with the president. He has presented himself as someone who has guided economies through crises before. In Canada, he was Bank of Canada governor during the global financial crisis. He was Bank of England governor during the UK's sort of tumultuous exit from the EU, rather. So he says that he has the experience necessary, but he has no political experience. So that's going to be the piece that Canadians aren't quite sure about. When it comes to China, that somewhat remains to be seen, but Canada did bring in those tariffs last year on China, really to align itself with U.S. policy on China. We were sort of extending an olive branch to the U.S. to say, we are with you every step of the way, to some extent, as you sort of take on this more aggressive trade posture toward China. And that doesn't seem to have benefited Canada when it comes to the Trump administration. So it will be interesting to see. We promised some additional tariffs on China that we have not yet imposed. And so that's an option we could bring forward, but it really depends on whether the US administration is paying attention and whether that will help us in our negotiations with them.
Okay, yeah, big question about where the spotlight really falls. Thank you so much for joining us. That's Laura Kane, Bloomberg's Ottawa bureau chief, burning the midnight oil for us. And coming up in the next hour, we have former Australian Prime Minister Malcolm Turnbull joining us as the country gears up for a federal election. Plus, we get his thoughts on the geopolitical turmoil unleashed by Donald Trump's tariff war.
Now, also joining us in the program, Jacob Kam, CEO of railway operator and property firm MTR, with his insights and really what's taking place across consumer and travel trends here in Hong Kong, counting down to the open of trade in Shanghai, in Shenzhen. Yep, the first session of the week, 17 minutes away. You're watching The China Show. Good morning. Good morning. You're watching The China Show. Just a recap of the inflation, or the lack of inflation numbers, which came through over the weekend. So seasonality in play. Obviously, you had the long holiday in January, the drop-off we had in pricing and price trends and price pressures post that Lunar New Year holiday and into where we are right now. Missed almost every single forecast out there with the exception of one. A 10-year yield is going the opposite way. We're now at 1.87%. There has been a melt-up in yields recently in China. Goldman Sachs out with a note here, zeroing in on really the two key parts here, right? Seasonality, definitely that was in play. But when you take a step back, it's also been too low, CPI and PPI, over the past 2 years, which underscores the distortion between supply and also demand. And I guess underscores the need for more policy support moving forward. Joining us now to give us their take is Wang, China Director at Eurasia Group, joining us today. First, good morning. Congrats on a new gig. We'll talk about that in a moment. I want to get your thoughts on what this latest inflation print tells us about the state of this economy right now.
Well, this figure is a pretty good illustration that this deflationary environment is a permanent rather than a transitory phenomenon. And the fact that the government actually lowered its inflation target, to me, is an open acknowledgement of this persistent phenomenon. And overcapacity plus a relative conservative monetary stance would actually prolong this deflation pressure rather than alleviating it.
Dan, what now is your outlook for March CPI and for 2025? And do the numbers that we've just seen coming through, does that affect, monetary policy going forward?
Well, inflation is ultimately a monetary phenomenon. And the fact that the central bank is pretty reluctant to cut interest rate by a great extent, of course, I have no doubt they will cut rates, cut triple R this year, but probably still lower than the market expectation. Because the ultimate goal is for this industrial transition to put more resources into high-tech rather than back into the traditional industries like housing. So as a result, they have no intention to blow up the housing bubble, but instead to focus on those long-term transformative technology. And when it comes to the manufacturing sector, the overcapacity is still across the board. And the commercial bank system in China has actually undergone this major structural change in the past 3 years. So their assets are now targeting to support even more of a low-cost financing towards the manufacturing industry, which will ultimately increase the overcapacity pressure. And that is another source of deflation.
So you've talked about the lowering of the inflation target to 2% being this important signal for policymakers. But how serious do you think policymakers actually are about tackling deflation this year?
I don't think it is as important as reaching other economic agenda, which is to ultimately fend off the threat from the U.S. And that's why doubling down its investment in technology and heavy industry is more key than tackling the domestic deflationary pressure. Because in order to address those problems, the government has to come up with a bigger stimulus in terms of boosting consumer market and housing. But so far, there is a lack of incentive for the government to increase the local government debt even further to make that happen. So the trade-in program probably will still happen, and I have no doubt in the short term it will bring up consumption, but still not to a great extent.
Can I ask you then what this might be or not indicating about this, this melt-up in government bond yields? I mean, several theories out there. One is this rotation out of bonds into stocks. That's one. The other is perhaps this repricing of future growth in China. And I guess I know where you stand on that based on your comments just now. And the other simply repositioning right now, or at least the lack of the repositioning on the back of the PBOC not being able to do anything short term on interest rates. Which camp are you in as far as why we are seeing this pullback in CGB yields?
Well, clearly there's an oversupply of long-term government bond, and there is a change in the capital market sentiment as well. And I believe this year the stock market probably will outperform because there's a sudden improvement of the prospect for the AI industry. And from the 0 to 1 invention, like the DeepSeek kind of breakthrough, the market suddenly have confidence. And then from the 1 to 100 type of AI deployment, the large-scale application, then China has even more advantage. So I guess this type of sentiment could actually last for a very long time. And it will probably support more investment in the stock market and causing more of a deviation away from the bond.
There is still some concern in China over the issue of overcapacity, particularly, of course, in the context of tariffs. What kind of supply-side reform are you expecting to see out of Beijing this year?
Well, one thing we have noticed is actually this bigger push for companies to find overseas market. So in order to win the global south, the government has set up different mechanisms to help set up factories in Greater Asia, even in Latin America, and also domestic banks are ready to help in different ways to financing their overseas investment. But to reduce domestic capacity is out of the question. We actually can see that in terms of the high-tech electric machinery, high-end equipment, robotics, that's actually getting more policy support and even cheaper financing. And they actually need to double down their overseas investment. We're probably seeing the start of this globalization of Chinese companies, and over time, there will be even more value added being created overseas than within the boundary of China.
Oh, interesting. So I was going to ask you about something else, but since you mentioned that, what does that mean longer term for the trade account?
Well, there will be even higher exports. I have no doubt about it. And even at this point, with all those threats from the U.S. tariff, we can still see pretty good momentum in that front. It's just that for Chinese companies, it will take a few years for them to repatriate those profits back to mainland China. So in the next 2-3 years, probably we'll see a deterioration of the national balance sheet. But over time, it will improve.
Wang, we are out of time. We didn't get to talk about your new gig, but I guess there's time for that. We'll see you back in the region, Wang, there in New York for us, China Director now at Eurasia Group. Right, counting down to the open of trade, the first session of the week, just under 8, going on 7 minutes away. We are called lower across these equity markets. This is Bloomberg. Right, welcome back. The first session of the week is just under 5 minutes away. U.S. futures are down 0.6%. That's generally what we're seeing across the region, and likely the approach, as you can see, we will be seeing, of course, I'm having trouble speaking. It's only Monday, but I think things can only get better from here.
Let me help you out.
Yeah, go ahead, please.
Big focus today is not reflected, obviously, in the optimism here, but is about the AI story.
Yes.
We've seen AI agent stocks, essentially this bet on multitask bots. So you have Beijing Kingsoft reinstated as a buy by William O'Neill. We also have UB Tech Robotics, 8 shares raised to buy at Suzhou Securities, as well as Horizon Robotics, rated now as a new outperform by Haitong there.
Yeah, and that really goes into what we're looking at today, AI stocks, AI-related stocks. And by the way, it's worth mentioning that when you look at the Manus AI story in particular, did already start to make itself felt late last week, going into the weekend. So it's a couple of stocks we're tracking going into the open today. Apart from that, right, in case you missed it, Beijing City also announced that it will be looking at getting primary and secondary students to start learning about AI. Right. In terms of that level to watch, right, 1.869% on the 10-year yield. Flip the page, and we're very close, the third ticker you see on your screens, to that level. That's a 100-day moving average. It's the first time we're testing that since the initial repricing of markets higher back in October. And we are getting a few more commentary coming through here. China AMC, BNP was also out with their commentary there. So, yeah, lots to watch as we're going into the open. This is Bloomberg.
Good morning and happy Monday. Welcome back. You are watching The China Show, and we're counting down to the open of markets this morning. 30 seconds off, Dave.
Yeah, so we are looking at the closing few minutes ceremonies, of course, of the CPPCC that's taking place in Beijing on your left, and really against the backdrop of markets that have rallied substantially. That's probably what you won't see going into the open today, broadly speaking. It's a day of mild risk aversion, There's a separate story, though, when you look at U.S. assets, right? So U.S. futures are down quite a bit right now. The dollar is coming off, U.S. dollar is coming off its worst week since, I think, in 26 months, thereabouts, November 2022. And of course, the commentary coming out of Jay Powell, that we can get to all of that in just a moment there. The open on the mainland CSI 300, there we go, flat at the open. There is one specific level we're tracking. We've been telling you about that on the Chinese 10-year yield coming up on your screens very shortly. That's the 100-day moving average, and we are approaching that quite quickly. In fact, that is at 1.86 and 7% and change. So commentary coming through there on this pullback in yields we're seeing.
Yeah, I mean, really, we've seen finally sort of this relentless decline since around October or so, but starting to melt back up. And it's over this sort of hesitation. Pan Gongsheng seemed to sort of signal this more hawkish stance that a rate cut may not be particularly forthcoming in the short term.
Yeah. Patience, I think, is what he's iterating there as far as the timing for future cuts are concerned. So that's really lifted the short end. And I think on the point Rebecca was making there, the likes of Wang out of BNP think the long end will now play a bit of catch-up because of the short end has pulled back a little bit. But here we go, right? So we are approaching the end of, I mean, we have a few weeks left, but I mean, 22 percentage points is the performance spread between MSCI China and the S&P 500. That's the biggest spread going back 18 years on a quarterly basis. So, you know, it's been really good to be long these markets. It's really, you've had to pay for it if you're underweight China, but, you know, how long that lasts is another thing altogether. Right. Some of the AI-related stocks, in case you missed it, Manus AI on the weekend. It's worth noting, of course, some of these have actually went limit up on Friday. So maybe a pullback right now as we try and sink our teeth deeper into more details on this. A couple of other movers, XPeng, big move up in U.S. session. The chairman talked about how next year, mass production of flying cars, keep your eye on that, 4.44%. Unisplendor is listed onshore. It's talking about, well, the initial work is being done, again, towards a Hong Kong listing. And in terms of earnings, we have Zhejiang Leap, and of course, property developer Wharf Real Estate is due out with earnings later today. Okay, let's get more on these Chinese markets. Joining us here on set, Catherine Ngai, who leads our Asia Stocks team, to help us understand what's going on. What are you guys talking about today?
Well, with the wrapping up of NPC, I think right now people are trying to digest to figure out what the next catalysts are, right? And we have the Politburo meeting kind of coming in a couple of weeks. That'll probably give us a little bit more sign. But, you know, given the poor CPI data over the weekend, I think the question right now is how will China sort of ensure and enact and execute the sort of big stimulus measures and the big sort of promises from the last week, and will the market believe those things, right? I mean, the market this past week has been very giddy. You know, all the numbers came in, all the promises came in. Sort of, I think most sell-side analysts would have, you know, we're going to tell you going into this that this was kind of in line. Things were as expected. This is all of the measures were sort of what people thought they were going to be, but still the markets had a wild rally. You saw last week the Hang Seng China Index and Hang Seng Tech both hitting 2022 and then respectively 2021 highs. I mean, people were really excited going into this, even at these sort of baseline expected measures, right? There's a very, very high, you know, anticipation here for more and for follow through. And so, you know, if we don't see that, if we don't see the sort of actual steps, this could all just crumble very quickly.
And a little bit, I guess, to your point of this sort of sobering up of this giddy market coming through today. That was Bloomberg's Catherine Ngai there with us on the very latest in Chinese stock markets. We'll, of course, be chatting more on that through the program today. We're also looking at Hong Kong's railway operator, MTR. They reported revenue for the full year, which beat estimates. Its stock now unchanged as we come into the open. We're now joined, though, by its CEO, Jacob Kam. Jacob, thank you so much and good morning.
Good morning, Rebecca. Good morning, David.
I want to start big picture thinking about property sentiment. What's the outlook and where are the more challenging areas?
Well, everyone is interested in that, in the answer of that question. In fact, I am interested in that too. But if I look at the properties developed by MTR, our properties have always been popular among the buyers, whether they are local or from other places, principally because our properties are well connected. They are always convenient, usually supported by a shopping mall nearby. So convenience is actually an efficient lifestyle is always what the Hong Kong people are looking for.
Yeah, what are you seeing as far as, and I know you have a lot more in the pipeline coming through these next few years or so. What are you seeing as far as demand in terms of price trends you're seeing?
We are in a harvesting period for our property development projects, but these projects are actually results from previous railway projects.
Yeah.
So the railway lines are already running, so we phase in property income so that we can actually sustain the long-term sustainability of the railway operations. So this is the harvesting period from the previous projects. The new ones also carry some property development, but they will, as planned, they will actually come in later on. Usually we will build the railway first, put it into service, and sometime during this period, property income will start coming in and will probably last for quite a few years afterwards.
That's a really good point on this sort of the pipeline. Now, one metric that's watched is, of course, land sales. And we have historically seen the government pull land sales when we haven't seen valuations come up to, meet expectations. How are you expecting, the timeline of land sales through this year? Are you expecting all of those to take place? How much flexibility is there?
Well, the government, I can't speak for the government, but from what we understand, they actually look at the actual supply and demand situations and they plan forward land sales for every year. They will also look at the focus area, for example, Northern Metropolis is a key development area. Therefore, they will be planning land sales near the area and also supporting the area. And we are part of the overall plan. We will also, of course, look at the market conditions before we commit to any land sales.
So public entities like the MTR have relied on using debt financing to support that pipeline. Of course, that has been under some pressure because of falling land sales, because of weakened demand for real estate in Hong Kong. How do you think about shoring up your future finances in that context of sort of this reliance on the debt model?
Yeah, the railway business is a long-term business, so we plan forward in a long-term way. So we just and of course to manage different cash flow needs, peaks and troughs, we have different financing means, and that is one of them. And we also plan our property development accordingly. So there are multiple ways of financing, managing our peaks and troughs in our cash flow going forward. And I have to emphasize that we are a long-term business, therefore we plan long-term, and we also plan our finance in a long-term way.
Can I pick up on that as well? You mentioned something earlier on that, certainly when you plan long-term, you try and predict what cash flows are in the future, and then you try and discount that to the present value. And I'm wondering, and the place I'm coming from here when I ask this question is, we're seeing some developers needing to discount some of the apartments that they're putting offline. And I'm wondering how that dynamic goes into your planning. Are you having to be more conservative now in terms of predicting your future cash flows from that specific source, for example?
Yeah. From the history of MTR, we have been deploying the rail plus property model over a long time. We have gone through ups and downs in the property market cycles. So in our long term, we take a fair value going forward, bearing in mind that this is a long-term development program. It's not just for next year or the next 3 years. We have property that will need to develop over the next 10, 12 years.
It's a good point that you're making on this emphasis on the long term.
Yeah.
Long term, Hong Kong is changing. And so I wonder, when you think about that, taking that very long view, how are you adapting the business model? How are you adapting your strategies?
Well, there are two levels of consideration. Of course, our recurrent business, both our railway business as well as our shopping mall, office, rental, and so on. We are facing a new normal after the pandemic. Okay, people's traveling behavior has changed. People's retail, buying, shopping behavior has changed. So we have to respond to that, to the new normal with new promotions, new ways of helping people to make journeys, make it meaningful. And of course, the market now emphasizes on experiential shopping as well as traveling. So we are working on those. Case in point is our high-speed rail service.
Yeah.
We continue to extend the number of direct destinations from Hong Kong, and business has been growing. Every year it breaks a record of patronage. So that's one area which is our recurrent business. The longer term would be our property development. We will have to match with the demand. And for example, recently, residential property is of more importance. Therefore, we are focusing on doing those. And we are actually working with Hong Kong government in the planning of those, the sequence of property development.
You have a few malls that are new, and I have to say those are great malls, by the way. So I've had the pleasure of walking through some of them as well. The changing consumer habits of Hong Kong, right? And you notice not just in your mall, across, that people are, they're there but they're not buying, or sometimes foot traffic. It doesn't seem to be pre-pandemic. How are you looking at future projects? And I'm talking about major strategic changes to the way you look at commercial businesses, for example.
Our shopping malls are, in a way, unique in that because they are well connected with the railway system.
Right.
Therefore, almost foot traffic is almost guaranteed. Okay, but now you have the people.
Yes.
How do
will they
you help
spend,
them?
Is the question. Yeah. Or will they walk through quickly?
Spend? That's right. So what we have observed is that the restaurant business, food and beverage business, is doing well.
Okay.
Unfortunately, they don't give us a lot of rent. So now we need to make sure that people not only spend time, they not only walk past our shopping malls, but they also spend time there.
Right.
They spend time having food and beverages, but they also spend time shopping. And we're also developing we're helping the tenants to develop what we call online, offline
Offerings?
Yeah. So they can actually combine their shopping both online and seeing the real things in our shopping mall as a combined buying experience. So we are, in a way, doing reasonably well, but rent has come down over the last few years. Okay, you mentioned that we have added new floor areas, rental areas, but our rent has not gone up in proportion to the increase in floor areas.
You're an engineer by training, so I want to pick your brains a little bit about that. Okay, you lost the bid for the Victoria line, but broadly speaking...
That's the Elizabeth line,
the Elizabeth line.
Yes.
What is the international strategy, and where do you see, globally, where do you see these opportunities for MTR?
We believe that we have developed over the years experience, not only in Hong Kong, but from other places, a good experience in managing railway assets, delivering good quality service. So wherever we go, we try to pass on that knowledge, pass on that experience. We help to train the local workforce, and that's exactly what we did with Elizabeth Line. So we opened the line, operate the first stage of the operations. We have passed on all our experience, our procedures and training to the staff. But when the contract is up, it required a retendering, and just like any tendering in the world, someone will win, and this time is not us. But our international business remains the same. We continue to look for opportunities where we can contribute with our experience and knowledge, but at the same time, of course, get us a commercial return.
I'm curious now. It makes me wonder, Hong Kong's not exactly the cheapest place in the world. So you have a footprint in Hong Kong, clearly. You have a footprint outside. How much more expensive is it to put up a station in Hong Kong compared to, I don't know, the world average?
Well, the world has a wide range.
Right.
Okay. For example, the stations that we put up in the mainland.
Yeah. Okay, let's compare to the mainland. Yeah, that's a good comparison.
A first-tier city, it depends on how complex it is. It could range from a few times less, or even almost as expensive. It really depends on whether it's deep underground, shallow underground, or even overground. That will vary significantly, even within the same city. Okay, so let alone different cities.
Right.
So, and we actually we operate with different models.
Okay.
The civil works is usually the most expensive, so digging the holes, digging the tunnels, laying the tracks, and all those. What we call electrical mechanical systems, like the overhead line, the control systems, the trains, they are usually less expensive compared with the civil works. So in different places, for example, the government in mainland and Australia, they will do the civil works. Okay, and then we will go in and install all the electrical mechanical systems and bring in the trains into the service. So there are different ways of making it happen. And also different time scale that people make it happen. And we, fortunately, we are experienced in working with different style, different environment, and making a success. Both, for example, last year we opened a new line in Sydney, M1, the city section crossing the harbour. That practically changed significantly the travelling pattern of the Sydney citizens, and we're glad to have help in that. And in Shenzhen, we opened a new line connecting to the land crossing at Shenzhen Bay. That also significantly improved the connecting transport arrangements in the area. So we are glad that we can be of help.
You know what? I could be here listening to you for a long time, actually.
So many questions. As a transport nerd.
Forgot you were on live TV. Jacob, let's do this again soon.
Yeah, please.
Sure.
Jacob Kam there, of course, CEO of MTR. And by the way, you can get an insider's guide to the money and the people shaking up Hong Kong in our Hong Kong edition newsletter that's out every Thursday. So you can sign up via Bloomberg.com/newsletters. Plenty more ahead. This is The China Show.
While other AI stops at generating ideas, Manus delivers results. We see it as the next paradigm of human-machine collaboration, and potentially a glimpse into AGI.
That was co-founder and chief scientist of Manus AI, which has gone viral on social media on claims that it has launched the world's first so-called general AI agent. Let's get a little bit more about what some are calling China's next DeepSeek moment with our tech reporter, Annabelle Jewellers. Annabelle, tell us, who is behind Manus? Why is it causing such a stir?
Yeah, well, maybe we can start with why it's causing such a stir, because it was only released just a couple of days ago at the end of last week, and the access right now is really limited. So it's still in its beta phase, and so you can access it only by invitation. There's a Discord channel that you can follow as well. But what we know so far is that Manus works like a general AI agent. So it's important to make the distinction here between what Manus can do and a sort of everyday chatbot, because a chatbot like ChatGPT, for instance, is human-led. You put in the text prompts and then it gives you the answers. This is about taking it to a different level where essentially you have what's called agentic AI, and which was seen as one of the big trends in AI for 2025. But agentic AI is when the AI tool can act autonomously and it's able to make decisions based on the information that's available to it. So Manus on the website lays out a lot of different use cases for this, like analyzing financial statements, screening job applicants, even deciding or proposing where you should live based on your certain requirements in terms of how much you can spend, the kinds of facilities that you're looking for here. It's basically, it seems quite limitless at this point in time, and that is also why, again, it's causing such a hype online, as well as really where it's coming from. And we understand that it's made by a group of researchers in China, and so it again points to that really stiff competition between the US and China, who can be in the lead on AI, especially when Manus is saying it can outperform OpenAI's own advanced AI agent Deep Research.
Such a deep bench in China is one of the aspects, I think. What do we know right now about the limitations?
Well, the limitations, I think, generally go back to the access, because, as I said, it's in the beta phase. Yeah. So right now you can only access it by invitation. So you can submit a request on Manus and give a reason for it. So I've tried as a Bloomberg journalist to get access to it. But we do have a Discord channel as well, and they're putting out some invitation codes on that. It's jumped to around 150,000 followers. So again, the emphasis on that. But there's a lot of different glitches that people are pointing out online, things like Manus crashing, giving incorrect information. But as I said, it's still in that beta phase. It's not fully open to the public just yet. We still need to get more details. How exactly has this technology been developed?
No, fantastic. Annabelle Jewelers there, our tech reporter. And yeah, we'll be talking AI too coming through. And yeah, do not miss this one. Big one with Alibaba.com President Kuo Zhang. Do catch that Tuesday, 7 a.m. in Hong Kong, 7 p.m. if you're watching out of New York. Plenty more ahead. This is Bloomberg. Right, in today's edition of Everyone's Getting Into Someone Else's Terrain, news here, this report out of the Science and Tech Innovation Express News. It's went out on Friday, in fact. It's playing out across markets right now. Huawei is setting up AI-backed diagnosis solution teams, and it's playing out as well across some of these medical technology stocks, as you can see there.
Yeah, that's right.
Interesting.
Yeah, really interesting. And the other item that we're watching closely is this Xpeng story. They have these plans to mass produce, I should say, actually, a flying car by 2026.
Yeah, that's going to be interesting. Are you going to get on that, though? A flying car? I mean, I have trouble enough trying to get into some of the taxis here in Hong Kong. They feel like flying already, if you think about it. The time we get to work early in the morning.
You should already be well prepared, Ben, Dave, okay? You know, some of our colleagues have taken some of these flying cars, tested them out in mainland China, and it is just extraordinary to see that technology develop so quickly in that ecosystem.
Yeah, well, the door's open for them. Maybe not me. Not just yet. I'd rather walk for now. In terms of equity markets, we're down a little bit right now in Hang Seng Index. We have changed direction several times right now. Nothing major, nothing of big swings here, but as you can see, we're generally across the board down. As far as the yield story goes, 1, 10, and 30. We're up ever so slightly. We are coming up highs of the day, though, as far as yields go. Plenty more ahead here on the China Show. We'll talk more about, of course, these markets. We have a question we're putting out there. Is it time to start pricing for a slowdown in the United States? Suffice to say, stay tuned for more. This is Bloomberg. Good morning and welcome to the show. We're entering the second hour here of the China Show, 30 minutes into the session here. So just coming off lows, as you can see, on the Hang Seng Index, 0.6 of 1% for a few brief fleeting moments. As you can see, we were up ever so slightly and we're pulling back a little bit right now. Call it even. I mean, we have been up several weeks in a row with the exception of one or two in the middle. HS Tech is up 0.6 of 1%. There's the Manus AI angle that we need to get into. Is that another DeepSeek moment, which, if you think about it, really kicked off this rally and why we're here at about these levels? We'll table that story for now. The other story we're tracking here in the Chinese markets has been this melt-up in yield. So the Chinese 10-year yield has now gotten to a point, and the chart shows you this, right, that we are now approaching the 100-day moving average, which reason that is relevant, we touched that level at the initial phase of repricing back in September when the PBOC came out and said they were going to stimulate. We hit that, and then we sort of retraced back down. Yet we're here again. So we'll see where we go with this. If you ask BNP, what they think is the melt-up on the short end recently means that the long end will eventually catch up. I won't get into the details here, but effectively the 10 and the 30 should be moving back, in their view, to the 2% level here, according to Wang.
Yeah, that's right. I mean, it's all about essentially this angst about when is the PBOC actually going to cut. We had this promise of looser monetary policy easing, but they've been so fixated on stabilizing the currency. We just haven't seen that come through. So a little bit of whiplash there.
Yeah, and the currency has been stable to that regard. But again, it's, they're giving up the short end of the yield curve too, and that might also have to do with the fact that you are getting a rotation out of the bond markets, which had paid well, into the equity markets, which is now, of course, alive and well. It's a case in point, right? The MSCI China is now on track for its best quarter against the S&P 500 in 18 years. We'll show you the chart in a moment. S&P futures down 0.5%. In fact, the our question of the day to our viewers right now is, should we start pricing in a U.S. recession? More on that in a moment, but I think let's also talk about some of the numbers which came through out of China on the weekend.
Yes, so we did see China's consumer inflation. We saw those numbers coming through. They fell below zero for the first time in 13 months. It's a sign that the economy is still facing a lot of these deflationary pressures. Bloomberg's China correspondent Min Lo joins us now from Beijing. Min, just give us the latest breakdown on the inflation data and which of those metrics and statistics caught your eye?
Yeah, so those price numbers really falling off again after a bump in January from Lunar New Year, and a part of it is a seasonal factor because Lunar New Year fell entirely in February last year, so we saw that big drop in food prices by 3.3%, weighing on the overall index there. But even if you strip out the more volatile energy and food prices, core inflation is still contracting by 0.1%. That's the first time since 2021. Only the second time in about 15 years, which shows you how serious this price deflation is in China. And you combine that with the imports number in January and February, a big drop of about 8%. You look at the consumer goods as well, down close to 1%. That's despite the government measures so far to subsidize equipment upgrading from households and businesses. You look at PPI, down 2.2%. That's the 29th straight month of contraction. So again, very persistent deflationary pressures here, which underscores how important it is for the government to double down on boosting domestic consumption. Investors still waiting for more details on how the government will do that, because the economic planner mentioned last week that they will unveil a new government action plan soon. We'll hear more details about that later. And as you said, monetary policy, the loosening of that, not so forthcoming just yet. We also had the livelihood presser on Sunday, where the Ministry of Social Security and Human Resources also mentioned that it's going to be an arduous task to maintain stability for employment and to keep that expanding, given that there will be 12 million new graduates entering the workforce this year. Come July, that's when you'll feel the pressure in the job market and on wages as well, and will have a negative feedback loop on consumer sentiment if the government can't hit that job target of 12 million jobs this year.
Min, on the tariff front, I know it's been busy for you there in Beijing. China's responded to Canada. What specific tariffs and when do they take effect?
Yes, so the tariffs will take effect on March 20th. China is imposing 100% tariffs on rapeseed oil from Canada and 25% on pork and certain seafood products. And this will have pretty significant impact on Canada because China imported about 6 million tons of rapeseed oil, almost entirely from Canada. And you can see the scale of these tariffs here, 100% and 25%. The tariff rates pretty much matching exactly what Canada has imposed on China in terms of the tariffs on the EVs and the 25% on aluminium and steel. So clearly China signaling here that they are willing to hit back hard against any potential future tariffs from Canada, given that Canada has been mulling or has been under pressure at least from the US to match those tariffs on Chinese goods. Plus, Canada also signaling they're willing to start early talks with the US to renegotiate or review that North America free trade agreement. So timing here is pretty interesting that China is choosing to release the results of their latest probe on that rapeseed oil at this time, about 5-6 months after Canada imposed those tariffs back in October. Very different response, the way China had dealt with Canada versus how they dealt with the US, where the tariff response had been much less proportional, signaling more room for negotiation with the US.
Mimi, I just want to pick up. You just mentioned the US there. We are seeing those tariffs come into effect today on food products. Explain why these are such an effective tool.
Yeah, so those are pretty wide-ranging sort of tariffs on many different things, 10 to 15% on things like wheat, soybeans, sorghum, beef, poultry. And of course, the American farmers are going to feel the pinch here. They're just a few weeks away from the planting season. U.S. shipments of soybean, about half of those last year went to China. So it's going to be a very significant impact there for American farmers. Bloomberg Economics saying that this move is particularly targeted to perhaps shift public public opinion in the US, especially from the American Midwest, people who supported Trump, and to shift public opinion towards this tariff war. So the court is now the ball is now in the US's court to see how Trump would respond to the latest retaliatory tariffs and how both sides will decide to move forward with that tariff negotiation, because high-level officials still haven't started negotiations on that front, even though we know the Chinese side have written a letter to the US side asking for a meeting and for more talks to take place.
Min Lo in Beijing for us, our China correspondent there. Let's bring in Sean Taylor, CIO and Portfolio Manager at Matthews Asia, joining us right now to talk us through these markets as we get warmed up for the week. The Chinese markets they've done well. I think the last time you were here, you're already bullish on the market. We've been seeing signs of consolidation in the last, call it, 2 sessions. No pun intended. What's the next catalyst?
I think it's interesting. If you compare the rally now, this year to last year, it's been very different. This year has been driven by tech. It's been driven, obviously, by AI, but it's also been driven by, and I think probably one of the most important factors for growth, a sort of warming up of the private sector with the meeting of President Xi and Jack Ma and the other private entrepreneurs. I think that's important because that creates jobs, ultimately. And if that is a sign that investment's going to continue, and there's going to be more money in the private sector, well, then I think there'll be more job creation. And you just look at the inflation data today, services is down. People still don't have confidence in Beijing and Shanghai. Salaries are going down, and they're not confident on spending, even though housing is seeing signs of recovery, certainly on sales, not on prices. So, when you go back to what the rally happened in September, sort of October, it was really driven by financials, by insurance companies, by the consumer. And, clearly we have a much better Chinese market driven by AI factors and also earnings upgrades and under-positioning, and also people switching from the US into China for that tech side. But we're not really seeing a clear movement in the domestic economy. When we see that, I think that will widen out, and we'll certainly have more participation in what I would call the old economy, and really which is driven by policy. So that's the next stage. I think now, they'll probably stall, people looking at China going, actually, China's changed, but it's 30% up. Do we buy now? Probably not. But we have to be careful as regional investors, because probably the larger stocks are going to be more attractive to the global investors. And I know we can look at the charts of some of the leading movers this year. They're up 50, 60%. But if you look at the long-term charts, they're way, way below the levels that they could be, going back to February 21. So I would have thought a bit of consolidation, more of a broadening out. You're already beginning to see it in Hong Kong financials, and then I expect you'll start to see it in the wider economy. But it might take a month or two.
I just want to push that hypothesis a little bit further. Sure. We're still seeing weakness in the Chinese consumer. We saw stimulus measures at MPC essentially meet consensus. Are we seeing the rally in tech driven independently of the fact of Beijing? Is this rally continuing despite what Beijing does and says? And does that matter?
I think the interesting thing is this is the first time that the market in the last few years has gone up without a policy hope. And so that's actually much more positive. And I do think, going back to 21, before the sort of regulation came in, people were writing like 90% of tax credits, 90% of job creation was done from the private sector. The private sector got a clear message that they were out of favour, and we had a massive derating in the market. So I think partly this is a re-rating. If you take the market or the PE of the market as a third the economy, it's not getting better, but it could. And they're putting in policy things to try and get it better, but it's going to take time. A third, geopolitics. Well, that's a lot better than we expected. It could go worse, but looks like it's getting better, or at least not getting any worse. And a third, attitude to the private sector. When we buy these companies, are we getting our money back? And that release, I think that's looking a lot better. And I think China, these companies have proved that they are as competitive as US companies in certain areas. So I think that's what's led it.
We mentioned earlier that, and I think our producer's about to bring the chart up, that MSCI China is set to outperform the S&P this quarter by the most in 18 years. So it certainly cost people money to be underweight China. But that's not rocket science observation. My question is has that message resonated enough, to your point, with the crowd that China's uninvestable? Are they starting to pay attention to that? So in other words, are people investing using geopolitical biases? Not so much along geopolitical themes, that's a different thing. And I'm wondering where your head is on that.
Yeah, look, I think it's still a question mark in the US, and certainly, our client base is still quite nervous, but nothing like a market going up to get people in. But actually, interestingly, this rally was started not by regional investors. Most people thought that there was value in China and were overweight like us. It was really driven by US tech investors. So there is a certain type of investor that is prepared to go on a bottom-up basis and buy. I still think there'll probably be a bias. I mean, look at the ETF flows into EM ex-China rather than into EM. I think that slightly will reverse, but I think people will still be nervous going into April. I still think people would like, in the US, want to see, is it sustainable? I think you were talking earlier on the show, the market's gone up 30%. We've been here before. What's the next leg? I do think it is sustainable, even though if it might consolidate in the short term. And I think then people will look at it and go, actually, we're very underweight China. And I think it will firstly, the next stage will be the EM and Asian funds, because there was a lot of international money who's completely ignored China. I don't think the US global accounts, China's too small in the index, etc. They can afford to miss it out. And it's been a very narrow rally, just like the S&P's been. But I do think wider, if you're worried about the US market, even these consolidating or going lower, particularly the stocks, you've got to be quite worried about some of the sort of correlated areas of Taiwan and Korea. India, I know a lot of the strategists are saying buy India, it's corrected. But we're seeing earnings revisions continuing to go down. And so maybe that's a second half of the year story. It means China's looking quite good relative within Asia as well. And it's sucking a lot of money out, sucking money out of Japan, sucking money out of, India a bit. We've seen massive flows out of India. But the main driver's been the southbound investor. The locals themselves are saying this is changing. And that's a really good sign.
Sean, while you're here and we have you trained at Sandhurst, you have a grounding in geopolitics. We're seeing what might be quite a fundamental shift in the US, moving away from being a sort of, the world's policeman, particularly when it comes to providing funding for Ukraine. How significant is this move? Does it affect markets in Asia?
I don't think it affects markets in Asia in the short term, but it might make Asia a safer place. Rebecca, we've had an incredible rally in Europe. Actually, we've had an incredible rally in Europe and China. Considering most people thought that the dollar was going to be higher and US exceptionalism, and it's just reversed. The catalyst, obviously, DeepSeek, we know in China. But in Europe, it's really been the election in Germany and the possibility of a peace plan. But I do think the ultimate, we've got to get used to an environment. This isn't just about Trump. I do think the American society or the American government, they don't want to pay for the European defence anymore. And, I'm not saying NATO's going to go, but, if something happened in someone like, Lithuania or another state tomorrow, would the Americans put troops there? I think that's questionable. But what's going to happen is Europe is going to have to step up with the United Kingdom and take over its responsibilities. And NATO will be an insurance policy, in my view, that, if you pay, you'll get insurance. If you don't pay for it, then it's going to be very difficult. So the US won't support it. But the trouble is, does European society, are they prepared for it? Because Europe has demilitarized, there's no investment going in there. It's going to cause a lot of clashes. I mean, looking at on Sunday morning in the UK, all the press and all the sort of TV shows, UK politicians are caught as well. They don't want to make a comment about America. They're supporting Ukraine. It's a very, very difficult time for Europe. So I think initially people will look at it and going, this is good for European equities, but going forward, I expect it's going to be tough for the European consumer and it's going to be tough for European growth because they're going to have to up the spending into the military. And it's not just going from 2 to 2.5. I think it's going to have to be 4 or 5, ultimately over time to catch up.
So when you mentioned it, that might make it safer, that might make Asia safer longer term, do you mean the markets or just generally the region in general in terms of security?
I just think, the markets in that way. Look, it's going to be difficult. I mean, there's clearly a threat. Hopefully we've got a ceasefire coming up, because that will make everything safer. But we're obviously going to have, after the ceasefire, we're going to have, there's huge questions about who's going to monitor it, what's it going to mean in the future, how does Russia play with, what's Russia's view on the world? I mean, obviously Russia has to probably rebuild its army and rebuild its economy, but it's going to be a threat like it was going back in terms of the First World War and Second World War. And I think that's going to make, have some very hard questions asked about Europe.
Yeah, and while we try and figure out, the world's overall average level of, say, safety and stability, is that a future premium that the markets will need to price in, for example? In other words, in 12 months' time, are we going to be in a safer place or not? And how does it affect my view of markets longer term?
Well, I think, ultimately Europe's become less safer, hasn't it? With a lot of the terrorism and, events that have happened in Europe over the years. But, I think risk premium in what you pay in the PE is going to be very, very important. 5-7 years ago, people were like, well, these are just stock selection markets. But we know countries matter. Yeah, so I think it's more moving over that way. So look, there'll be some European countries that really get it and step forward, and there'll be some that probably don't. So it's going to be challenging. But it's a really interesting time in politics, obviously, because you've had, a turn to the, in some countries they're divided between, are they going to go left or are they going to go really extreme right? And that middle ground's gone. Interesting enough, in Latin America, there seems to be the opposite happening, and just something to look over for the next sort of 18 months. You're beginning to see that left-wing governments getting challenged, and maybe right-wing. There's going to be more from the right. So more of a pivot away from China and Russia, and more of a pivot towards the US.
Choong, we could have you here forever.
Sorry.
No, we're going to have you back to answer all of the questions you just posed
that was
to
our
yourself.
fault, actually.
Sean Taylor there, CIO and Portfolio Manager at Matthews Asia. Stay with us. You're watching The China Show. This is Bloomberg.
Right, welcome back. In case you missed it, shares of Tesla are now down 45% from the peak. December 17th, I believe, is the date for that. Now, erasing effectively all its gains since the elections. That translates to $700 billion of market cap that's been wiped out. What it means for Elon Musk, well, it means, of course, this is first one of the worst performing stocks, the worst performing stock, in fact, on the S&P since that point in time. Specifically for Elon Musk, he's now just worth $330 billion. He's off by about $130 billion since that point in time. He's been facing backlash, of course, Rebecca.
Yeah, absolutely. I mean, to that point, we've seen these protests emerging over the weekend, particularly in the US. So Musk facing backlash over his role in the Trump administration. Tesla dealerships across Europe and North America have been the target of protests. But, and a big but, there is no similar backlash in China, although the prospects for Tesla in that market are dimming. We see data from China's Passenger Car Association, for example, showing Tesla's sales in the country fell 49% in February. During the same period, its top rival, BYD, saw a growth of more than 160%.
Yeah, let's take a closer look with David Fickling, our Bloomberg opinion columnist. David, tell us about your thesis here on Tesla's problems in China.
Yeah, I do think there is something different going on. As you see, there has been this, this Tesla takedown movement happening. I mean, I think the classic example of this, I think 76% sales were down in February in Germany. And of course, that was at the same time that Elon Musk had endorsed this far-right Alternative for Germany party in the elections. And, really got a very bad reputation there. We've seen Sheryl Crow handing back her Tesla and donating the money to National Public Radio. In my block in Sydney, there's a red Model Y that's parked, and they've stuck a bumper sticker on there saying "not an endorsement" with the word Elon crossed out. So you can see there's a sort of mass market protest going on. A mass protest going on there of some sort. Of course, China is different because mass protests are not something that is particularly smiled on in China, and I think there's some other factors there to do with the fact that it's just a much more mature EV market as well.
Yeah, so on that point, the level of maturity in that market, the competition that Tesla is facing, just lay out why sales in China are still so down for Tesla.
Yeah, well, I mean, first, I just want to make the point about the public image of Tesla and rather of Musk and Musk's family in China and how that's quite different, because I think that's a significant factor in this. And that reflects the fact that, his mother, May Musk, who I think is pretty much unknown outside China, is a genuine bona fide celebrity there. She's got 700,000 followers on Xiaohongshu. She visits the country regularly. She gets very approving responses. She's got a memoir that she claims is a bestseller. It certainly seems to be doing. I know lots of Chinese people who authentically are big fans of May Musk. She's 76. She's very good looking. She's very she has a telling life story. And Elon Musk himself, obviously, he's done a lot to stay on good terms with the government in China. He sort of voices the government line on issues like Taiwan and decoupling, and he's quite friendly with Li Qiang. They just opened a new battery factory in Shanghai last month. So all those factors, the sort of political factors of Elon Musk and Elon Musk's personal image and his family image, it's a real liability for Tesla in most of the world. But in China, I just don't think that's the case. So I think there is something going on, and that's really to do with the nature of the market.
Right, thank you so much. Bloomberg opinion columnist David Fickling in Sydney there with so much on the ground colour for that Tesla story. Do find that and read that on the web. There's plenty more ahead. You are watching The China Show. This is Bloomberg.
Welcome back. Here's a story, well, two stories I guarantee you we'll be talking about over the course of this week. CGBs have brushed off the earlier weakness, and as you can see now, yields are pushing lower. Call it flat. We were higher earlier on. The extent to which this continues is a question, of course, and the massive pullback we've seen in yields. That's story number one. Story number two, this pullback and peeling back in U.S. futures. There we go. So these aren't moves you normally see to this extent. This time of the day in the Asia Pacific, down 0.5% on the NASDAQ 100. Plenty more ahead. This is Bloomberg. Right, welcome back. Going into the Japanese lunch break, we're down 0.25% on the benchmark, and the Nikkei is going the opposite way. And some fairly, again, encouraging data coming through out of Japan. Wage gains here, Rebecca. Yeah, wage gains. Well, the fastest gains in base pay in 32 years for the BOJ. It rose 3.1% in January. It's pretty extraordinary. Biggest jump since 1992. Yeah, how I wish to. Let's all move to Japan and. Earn in yen. Maybe not. Let me rethink that thesis first. Cuts both ways, right? Asia ex-Japan is looking like this across sector groups right now. So Japan is doing well going into its lunch break. Overall, though, I'm going to spend too much time on this. Most sectors are down as we get warmed up this Monday. Yeah. Elsewhere, I mean, geopolitics, we were just talking with Sean Taylor out of Matthews, Asia, about the significance of whether or not the US continues to be the sort of security guarantor for Europe. We'll be continuing some of those geopolitical themes now. Australia Prime Minister Anthony Albanese signalling that a federal election will be happening in May. That's after he ruled out calling for an election over the coming weekend. Let's head over to Sydney now, where the Asia Trades co-anchor Heidi Stroud-Watts is standing by with our very next guest.
So my line is you, Heidi.
Rebecca, Dave, thank you. And of course, it's not just domestic political issues at stake here when it comes to the upcoming federal election, but also the changing geopolitical world that we now find ourselves in, particularly with Australia being this sort of key middle nation role. And with me is the former Australian Prime Minister, Malcolm Turnbull, to talk about all these things. And, of course, you've had experience dealing with President Trump in the first iteration. His return to office, has it been a month and a half? Seems very chaotic. Do you think it's been more chaotic, less chaotic? Do you think it will get more uncertain?
Who knows? I mean, it has been. You've had tariffs going on, going off, going back on again. And this uncertainty, as you know, excuse me, better than anyone at Bloomberg, it's hitting the markets too. I mean, it's bad for business. So it is I would say this time he is more determined. He's got a team that is totally on board with him. You know, he's surrounded by yes men, supporters. And the first Trump administration, he didn't really expect to win. He wasn't really prepared. He hired a lot of people that were not from his camp or his MAGA movement, and they were trying to steer him in more conventional directions. But, you know, he hasn't got that restraint now. So you're seeing a much more undiluted Donald Trump second time around.
A clearer mandate, perhaps, if you will, this time?
Well, he's got, yeah, sure, he's got a mandate, but I don't think Americans will feel that would be happy if inflation starts to go up or they, you know, go into recession. Or, I mean, there's a lot of people are very pessimistic about the consequences of his policies. I mean, if this triggers a global wave of protectionism around the world, that's clearly going to be bad for business everywhere. You know, Trump seems to have a view that America can prosper at the expense of everybody else. But that's not going to work. That's what they tried that at the time of the Depression, you know, with the Smoot-Hawley legislation, which only made the Depression worse.
It's always difficult for Australia, of course, given the huge economic dependence on China and the huge security alliance with the US. I mean, the administration has ripped up the playbook when it comes to Europe, for example, what it's doing with Ukraine. What's the best way that Australia can manoeuvre this?
Well, look, we are by no means as economically dependent on America as, for example, Canada is. So, you know, we actually have a trade deficit with the United States, something Trump appreciates. He likes having a surplus. The big risk to us is not so much tariffs on Australian exports like steel and aluminium, but rather a slowdown in the global economy, in particular the Chinese economy, which is the destination for much of our exports. In terms of how do we handle it, look, I think we have to. We're not going to change Trump. But what does this mean? It means we have to look at all of our defence and security relationships with a fresh eye. We have to be more self-reliant. We have to assess how we can defend ourselves. We cannot count on the Americans supporting us in the way we have before. It'd be naive to do that. I mean, look at what they've been doing with the Europeans. Why do we think we are more beloved or more important to the Americans than the Europeans are? I mean, people have said to me, oh, the Americans have got, you know, military personnel based here. They've got tens of thousands of military people in bases in Europe, and yet they've basically walked away from the Europeans, particularly over Ukraine. Look at the way he's, you know, cut military aid, suspended intelligence sharing with Ukraine, thereby advantaging Vladimir Putin on the battlefield. When Putin ramped up his attacks on Ukraine in the last 48 hours, Trump said, oh, well, that's just what you'd expect him to do, as though that's completely okay. So this is a very different United States. Trump does not subscribe to the same values that we have in the past shared with America. He doesn't have a commitment to the international rule of law, that's obvious. Doesn't care about treaties or alliances. You know, he's got a free trade agreement with Canada and Mexico, which he entered into, by the way. He signed it. Then he's just walked away from that. So I think we have got to work out how we are going to defend ourselves and how we will pursue a more independent of the United States approach to international and security affairs.
That sounds like you don't expect an exemption for tariffs for Australia.
Look, I think I secured one back in 2018, but I think it's going to be a lot harder this time. And the reason is that I think they will, Trump will be being told, and I suspect he'll conclude himself, that you give one country an exemption, then you have to give another, and before long there are too many exemptions and you haven't got much of a tariff. So I suspect it will be on everybody. Australia does have a couple of things going for it. They're really exactly the same arguments. I mean, it's a case of rinse and repeat. I mean, the government is using exactly the same arguments I used in 2018, namely that Trump has a surplus with Australia, he's got free trade deal with Australia, there's no tariffs or barriers to American trade or investment with this country, and a steel tariff in particular will only put up the price of roofing materials in California, and it won't result in any additional American steel production. And to give Trump credit, I went through all of this in great detail with him, and I've set it all out in my memoir. If anyone's interested in it, it's all there. But I think the argument...
Is he right in saying that the promise on aluminium export volumes was broken?
Well, I didn't give that promise, okay? So aluminium was barely mentioned in my time. All the focus was on steel. Aluminium was just a footnote because the tariff was only 10% at that time. But apparently when Morrison was Prime Minister, the Americans had noticed aluminium exports from Australia were increasing, and Scott gave some kind of undertaking that they, wouldn't increase. That's what's said. I wasn't there, obviously, but it certainly wasn't an undertaking that was given in my time.
I wanted to get your view on the live fire drills from Chinese military in the Tasman Sea. Of course, the huge amount of concern over Chinese warships as well. What's your view on this in terms of the way that we sort of navigate this with Beijing?
Well, look, China's perfectly entitled to sail their naval vessels, wherever they like. They're in international waters. They're entitled to have a live fire drill. It would have been much more polite to give more notice, and the Australian government has protested about that. But I think what's the purpose of it? Well, it's a show of strength. I mean, China is, a giant economy. Its economy has grown. Its military has grown in line with the size of its economy, and it has a blue water navy. And it is, showing its strength. Its navy sails all around the world. And so, this shouldn't come as a surprise to us or an affront. This is something we've got to take into account, and it underlines why we have to be able to defend ourselves.
And I know you've had conversations with the presidency in the past, and this feels like an opportunity for Beijing, right, to sort of step up in the new global world order. Where does Australia fit in terms of that relationship with China?
Well, I know we had a difficult period a few years ago, but I think our relationship with China is much improved now. There was an unfortunate period where China overreached, frankly, and they engaged in economic coercion of Australia, and you had all of the bans on Australian exports to China. That was a mistake, and it didn't work. Backfired, and it's been rolled back. So that's good. We should have a mutually respectful relationship. I think China will take massive advantage of Trump. What my prediction will be that President Xi will aim to be the exact opposite of Trump. Where Trump is chaotic, he will be consistent. Where Trump is rude and abusive, he'll be respectful. Where Trump is erratic, he will be consistent. And what that will do is build trust with countries, and there'll be many countries who will, looking at China on the one hand and Trump on the other, will find China a more attractive partner. So Trump is not just helping Vladimir Putin on the battlefield in Ukraine, which is bad enough, but by his own conduct, he's providing an opportunity for China this time to take a different approach than the one they did with Trump 1. And really, as I said, they should be the anti-Trump. I mean, they don't have to be against him, they just have to be the opposite of him in terms of style and the way of dealing with people. I mean, the way Trump looks at the moment is, and this is every commentator, leaders all around the world are making the same point, it appears that the more dependent you are on the United States, the closer you are to the United States, the more he feels he can extract value from you, stand over you, extort you. I mean, look at the business with Greenland. I mean, is this Denmark's reward for supporting the Americans in Afghanistan? Is that their reward? To have their Prime Minister rung up and told that her country has to cede one of its territories? I mean, is this Canada's reward for decades of solidarity and alliance, that they should be told they're just the 51st state and be threatened with tariffs that are going to send the country into a recession? This is not. Yes, he is the President of the United States, but that is really the only thing he's got in common with his predecessors. This is a very different America, led by a very different president.
I wanted to ask about your views on the economy and confidence here in Australia. Some of the indicators are starting to, turn around, and I do wonder, though, in terms of the sort of structural reforms, policy innovations. We've seen China, for example, really looking to revive the private sector, tech innovation.
Yeah.
Is Australia missing that sort of impetus as we head into this election?
Well, I mean, the tech sector is very strong in Australia. If you go back 30 years, when I first got involved in the tech sector as a venture capitalist, there was no venture capital here. Now, and in my own government, the National Innovation and Science Agenda in 2015 gave a lot of impetus to investment in tech and innovation generally. And I think this sector is healthy, but it can always, what government should be doing is staying close to that sector and making sure that they're providing the support and incentives that will continue to drive it along, because innovation is the key. I mean, innovation is the key to productivity. That is how you stay ahead of the pack.
So great to have you on with us. We appreciate your time today. That was the former Australian Prime Minister Malcolm Turnbull here in Sydney. Dave.
Heidi, fantastic. Heidi Shard-Watts, our Asia Trade co-anchor, of course, there in Sydney for us. Now, for Bloomberg subscribers, in case that you missed that conversation or some of the others, of course, that we've had here on the TV, on Bloomberg TV so far this Monday, you can check it out on TV Go. Scroll back. You can scroll back a little bit to get to that conversation with Heidi, or scroll back a little bit further to some of the others that you might have missed over the last, let's call it 3-4 hours or so. Plenty more ahead. This is Bloomberg. China is working to crack down on scams, but its heavy-handed and sometimes intrusive approach has some raising questions about privacy. Let's bring in Colin Murphy, our government reporter in Beijing, for us to tell us what they're doing, what's happening here. Yeah, Colin, why don't we start with the scam firewall? How does it work? What are the tools that China has at its disposal, and how are they deploying those tools?
Right. So it's a very impressive network where China is mobilizing a combination of police, banks, telecom and internet providers, and it's all part of a scheme to fight against telecom or internet scams. So, for example, we had one anecdote in the story that talks about a Shanghai retail worker who was sitting at home and then got a phone call from overseas. And when, within a couple of minutes, the local police had not only reached out to that person by phone, but had turned up at his apartment and gave him a little bit of a lecture about, not to get involved in scams, and they required him to sign a document. So basically what we're seeing is this campaign, which has been a priority, I must say, since 2021 for Xi Jinping, but now we're starting to see the tangible results. And one of the tools that they have, obviously, is that they've empowered this National Anti-Scam Center under the Chinese cabinet, and they've devised a number of mechanisms. There's an app, for example, that has had 2.5 billion installations since early 2021. There's a hotline where people can call to report suspicious behavior. And so these mechanisms, together with the use of big data, but also requiring banks, telecom operators and internet providers to work closely with the authorities, that has allowed the Chinese government to assert that, say, in the period as of May 2024, they had intercepted some 7 billion phone calls and a similar number of texts, and had set up around 18 million in-person meetings, just like the ones I mentioned earlier. All told, they're saying that has helped China prevent scams to the value of 1.1 trillion yuan.
Those statistics are a great point in terms of the scale of the response from authorities here. I wonder how Chinese people are responding to that. Do they feel it's heavy-handed? And is it distinct from the type of surveillance that we see of political dissidents, for instance?
Right. In terms of the political dissidents, and one thing we can say that does set it apart, that typically is done by the national security officers, whereas in this case we're talking about mainly frontline policemen and in particular and women, and in particular neighbourhood police. And what does that mean? It means like in many buildings, in apartment buildings in China, you have photographs in the lobby of your local police person, and there's a sense of familiarity. They have their telephone numbers, and in that regard they're not considered to be as intimidating, if you will, as other types of police and other types of national security officers. So on the whole, I would say from the reporting at least, we see that many people do welcome this. They see it as the authorities looking out for them and being proactive and preemptive in terms of like taking care of them and preventing them from becoming victims of fraud. But of course, there are parallels, there are sort of echoes to COVID when we had a similar sort of closely monitoring of people. And there are people, of course, that will have concerns over personal privacy and data. But generally, we can say that the scheme so far, the project so far, has been successful and is widely welcomed by many Chinese.
Okay, China government reporter Colin Murphy there, joining us in Beijing. And terminal subscribers can read the full story with the function NI Big Take. That piece is also available on the website, Bloomberg.com. Really some fascinating anecdotes and colour from on the ground on the extent of authorities' response to some of these scams there. Really well worth the read. Stay with us. You're watching The China Show. We will have plenty more ahead. Good morning. You're watching The China Show. Here are some of the top political stories that we are following today. Russia is said to be willing to discuss a temporary truce in Ukraine following this progress towards a final peace settlement. Sources say that offer was conveyed at last month's talks in Saudi Arabia between top Russian and American officials. They say for a ceasefire there needs to be clear understanding of the framework of the final peace accord, including an eventual peacekeeping mission. President Trump says he still expects his Ukrainian counterpart, Volodymyr Zelensky, to strike a minerals deal with the US. Speaking with Fox News, he again accused Zelensky of being ungrateful for US support. Officials from both countries are meeting in Saudi Arabia this week to resume talks for a possible ceasefire between Ukraine and Russia. A US negotiator says a new Gaza ceasefire deal is possible within weeks. Adam Bola told CNN the possible agreement could even see Israel recover all hostages held by Hamas. A six-week truce expired earlier this month, with both sides divided on conditions for more suspension of hostilities. Israel has since halted its limited supply of electricity to the Gaza Strip in the response to the crisis. And former Philippine President Rodrigo Duterte says he's ready to go to jail if the International Criminal Court orders his arrest over policies to suppress the drug trade. Speaking in Hong Kong, Duterte defended his anti-narcotics campaign, which killed over 6,000 people. The ICC is investigating the former president's drug war for possible crime against humanity.
Right, before we wrap up the show, we're going to breeze through certain subplots across these markets. So Honhai, as you can see, was down. It's now unchanged here. Some news earlier on, I would say about 20 minutes back. So you had the Research Institute launching this traditional Chinese large language model, which, effectively they're saying has reasoning capability. Just to note that the company is coming out with earnings, I believe, in a couple of days. So just mark your calendars now. Right, city planning stocks. Some of these are traded onshore, most of which, at least, there we go on your screens here. This is on the back of the Chinese housing minister promising to include old urban communities built before 2000 into this renovation scheme. And as you can see, that's playing out and really boosting some of these related stocks on your screens. Very briefly, when you look at U.S. futures, this is, I guess, a story to track on the macro front going into today. And, of course, the pullback we're seeing in HS Tech was down as much as 2%. So, yeah, these are sizable moves we're seeing here, coming off a bounce on Friday. But, of course, in case you missed that, entering a technical correction as far as U.S. tech stocks are concerned. And, of course, the dollar on your screens after the worst week for the US dollar going back 24, 25 months. Some signs of stability. You are seeing some signs, though, that the dollar-yen trade to the downside might be gaining too much momentum, could be approaching, I guess, a buying window there, of course, when you look at some of these charts.
And coming up, we also have the PepsiCo APAC CEO joining us exclusively to talk about consumption trends in China and the opportunities that she is seeing on the mainland. That's it for the China Show. Insight with Aslinda Amin is next. Stay with us. You're watching Bloomberg.